Before we dive in, please remember that the information provided in this video is for educational and informational purposes only. It is not intended as financial, investment, or trading advice. The foreign exchange market is subject to a high level of risk and is not suitable for all investors. You should be aware of the risks and be willing to accept them in order to invest in the markets. Past performance is not indicative of future results. Please conduct your own research and consult with a qualified financial professional before making any investment decisions. Have you ever been watching your charts, everything calm and quiet, when suddenly out of nowhere, an invisible force slams into the market? A currency pair that was barely moving suddenly skyrockets or plummets 100 pips in less than a minute, wiping out stops and triggering chaos. You scramble to find the reason, and you see a headline flash across the screen. U.S. jobs report shatters expectations, or inflation comes in hotter than forecasted. It feels random, unpredictable, like trying to trade during an earthquake. You're not alone. For millions, these economic news events are a source of pure frustration. It feels like you're playing a game where someone else knows the rules and you don't. But what if I told you it's not random? What if there's a logic to the madness? What if you could learn to understand the language the market speaks when this news is released? This isn't about having a crystal ball to predict the numbers. This is about something far more powerful: understanding the why. Why does a report on jobs in Ohio and California cause the Japanese yen to move? Why does a number about the price of gasoline in America send shockwaves through the Australian dollar? In this presentation, we are going to pull back the curtain and demystify this entire process. We're going to build a foundational understanding of exactly how and why major U.S. economic news acts as the central engine for the entire $7 trillion a day Forex market. We're going to turn that chaos you feel into clarity, so that the next time a major headline hits, you're not caught by surprise. Instead, you'll understand the chain reaction that's about to unfold. To do that, we first have to start with the one single concept that underpins everything: the role of the U.S. dollar itself. The dollar isn't just another currency. It is the sun in the center of the financial solar system. It's the world's primary reserve currency. What does that mean? It means central banks from Beijing to Berlin hold massive amounts of their national savings in U.S. dollars. It means critical global commodities like oil and gold are priced and traded almost exclusively in U.S. dollars. When Brazil wants to buy oil from Saudi Arabia, that transaction happens in dollars. When a Japanese company wants to buy copper from Chile, they use dollars. The dollar is the global operating system for money. Because of this, the health and strength of the U.S. economy isn't just America's business. It's everyone's business. A strong, stable U.S. economy means a stable foundation for global trade. A weak or volatile U.S. economy creates uncertainty and fear that ripples across every other market on the planet. This is why when the United States sneezes, the world braces for a cold. And the economic news reports we're going to discuss? They are the official medical checkups on the health of that economy. They are the vital signs that every other country, every major bank, and every serious trader is watching. Now, if the U.S. economy is the engine, there is a driver with their hands firmly on the wheel. This is the second critical piece of the puzzle: the U.S. Federal Reserve, or the Federal. The Fed is the central bank of the United States, and it has one of the most powerful jobs in the world. They have a dual mandate, a two-part mission given to them by Congress: to achieve maximum employment and to maintain stable prices, which essentially means keeping inflation under control. Think of the Fed as the conductor of a massive orchestra. Their primary instrument to control the economy is the federal funds rate, which is the interest rate at which banks lend to each other overnight. This one interest rate influences every other interest rate you can think of: your mortgage, your car loan, your credit card, and most importantly for us, the return someone gets for holding U.S. dollars. Here's the simple logic that drives trillions of dollars in decisions. When the Fed raises interest rates, it becomes more attractive for international investors to hold U.S. dollars because they can earn a higher return, a higher yield, on their money. This increases the demand for dollars, typically causing the dollar's value to rise against other currencies. Conversely, when the Fed lowers interest rates, holding dollars becomes less attractive. Investors might sell their dollars to buy currencies of countries with higher interest rates, causing the dollar's value to fall. So here's the key connection. Every major piece of economic news, every report on jobs, inflation, or economic growth, is a data point that the Federal Reserve uses to decide whether to raise, lower, or hold interest rates. Traders in the Forex market know this, so they aren't just reacting to the news itself. They are reacting to what they believe the Fed will do in the future because of that news. They are constantly trying to get ahead of the Fed's next move. A strong jobs report isn't just good news. It's a signal that the Fed might raise interest rates to keep the economy from overheating. That's the real reason the market moves so violently. It's a global chess match where everyone is trying to predict the conductor's next decision. This brings us to the reports themselves. While there are dozens of economic releases every month, they are not all created equal. There are three heavyweight champions, the big three reports that have the most significant potential to move the market. These are the reports that the Fed, and therefore the world, watches most closely. They are employment, inflation, and growth. First, let's talk about employment, specifically the Non-Farm Payrolls report, or NFP. This is the Super Bowl of monthly economic data. Released on the first Friday of every month, it measures the number of jobs created or lost in the U.S. in the previous month, excluding farm workers, private household employees, and nonprofit workers. Why is it so important? Because a healthy economy creates jobs. When people are employed, they have money to spend. When they spend money, businesses thrive and the economy grows. A strong NFP number is a powerful sign of economic health. It signals to the Fed that the economy is robust, which might lead them to consider raising interest rates to fend off potential inflation. A surprisingly weak number does the opposite. It signals economic trouble, potentially forcing the Fed to consider lowering rates to stimulate growth. The second heavyweight is inflation, primarily measured by the Consumer Price Index, or CPI. Think of CPI as the economy's fever chart. It measures the average change over time in the prices paid by urban consumers for a basket of consumer goods and services, everything from milk and bread to rent and gasoline. Inflation is the Fed's arch-nemesis. Their primary goal is price stability, which they define as an inflation rate of around 2%. If CPI comes in hot, meaning inflation is rising much faster than that target, it's a massive red flag for the Federal. It signals that they may need to act aggressively, raising interest rates to cool down the economy and bring prices back under control. For the Forex market, a high inflation number can often mean a stronger dollar, as traders anticipate these rate hikes. Finally, we have growth, measured by the gross domestic product, or GDP. This is the economy's official report card. It represents the total monetary value of all goods and services produced within a country's borders in a specific time period. It's the broadest measure of economic activity. A strong GDP growth rate shows that the economy is expanding and healthy. However, just like with the other reports, context is everything. Extremely high growth can also lead to inflation, putting pressure on the Federal. A negative GDP reading, on the other hand, signals a contraction and is the technical definition of a recession if it happens for 2 consecutive quarters. In that case, the market would expect the Fed to cut interest rates to try and jumpstart the economy. So there you have it, the foundation. We have the king dollar, the global currency that everything is priced in. We have the Federal Reserve, the powerful conductor using interest rates to manage the economy. And we have the 3 critical data points they watch like a hawk: the jobs report, the inflation report, and the growth report. Understanding this framework, how these 3 elements interact, is the first most crucial step. It's the difference between being a passenger tossed around by the waves of the market and becoming a navigator who understands the currents, the tides, and the weather patterns that cause them. This is the core logic that turns headlines into market action. Now that we've laid this essential groundwork, we're ready to put the first and arguably the most explosive of these reports under the microscope: the non-farm payrolls. It arrives like a thunderclap on the first Friday of every month, precisely at 8:30 a.m. Eastern Time. For the 60 seconds leading up to that moment, the global Forex market holds its breath. Liquidity, the lifeblood of the market, evaporates as major players pull their orders, waiting. It's a digital ghost town. Then the number hits the wires, and in the blink of an eye, a tsunami of volatility is unleashed, capable of moving major currency pairs hundreds of pips in a matter of minutes. This is the Non-Farm Payrolls report, or NFP. So what is this report that commands so much attention? In simple terms, the NFP is the United States monthly report card on its job market. Released by the Bureau of Labor Statistics, it measures the number of jobs added or lost in the U.S. economy over the previous month. The key here is the term non-farm. It excludes farm workers, private household employees, and nonprofit organization employees. Why? Because these sectors can be highly seasonal and volatile, and by removing them, the report gives a much clearer, more stable picture of the underlying health of the economy. Think of the US economy as a massive corporation. The NFP number is its headline earnings report. It's the single most watched indicator of economic growth. When businesses are confident in expanding, they hire more people. The NFP number goes up. When they're fearful and contracting, they stop hiring or lay people off. The NFP number goes down or even turns negative. It's that direct. Before the release, economists and analysts across the globe publish their forecasts. They'll say, "We expect the economy to have added 180,000 jobs." This forecast becomes the benchmark, the line in the sand. The market's reaction isn't just about the actual number. It's about how the actual number compares to that expectation. A huge beat, where the number comes in way above the forecast, signals a booming economy. A massive miss signals trouble. But the NFP is not just one number. It's a package of data, and the real story is often in the details. There are three critical components you have to understand. First, you have the headline number itself. This is the one that gets all the press. US economy adds 250,000 jobs, smashing expectations. This is the initial catalyst. A strong number suggests robust economic activity, which fuels expectations that the Federal Reserve might need to raise interest rates to keep the economy from overheating. As we discussed, the prospect of higher interest rates makes the US dollar more attractive to foreign investors seeking a better return on their money. They sell their own currency by dollars and the dollar strengthens. Second, there's the unemployment rate. This is presented as a percentage like 3.7%. It represents the percentage of the total labor force that is unemployed but actively seeking employment. A lower number is generally better. It indicates that most people who want a job can find one. However, this number can be tricky. Sometimes the unemployment rate can fall for the wrong reasons. For example, if a large number of people get discouraged and stop looking for work, they are no longer counted as part of the labor force, which can artificially push the unemployment rate down. That's why traders look at this in conjunction with the headline NFP number to get the full story. A falling unemployment rate combined with strong job creation is the gold standard. But the third component is arguably the most important for understanding the future of interest rates. Average hourly earnings. This tells us how much workers' paychecks are increasing. Why does this matter so much? Because it's a direct pipeline to inflation. If wages are growing rapidly, people have more money to spend. This increased demand can push the prices of goods and services up. The Federal Reserve watches this number like a hawk. Their primary mandate is to maintain price stability, which means keeping inflation in check. If they see wages accelerating too quickly, they see a flashing red light for future inflation. This puts immense pressure on them to raise interest rates to cool things down. A strong average hourly earnings number can sometimes be even more powerful than the headline NFP number in moving the dollar higher. Now let's bring this to life. Let's walk through three common scenarios on NFP Friday. Scenario 1, the blockbuster report. The clock hits 8:30 a.m. The forecast was for 180,000 new jobs. The actual number comes in at 300,000. On top of that, the unemployment rate drops from 3.7% to 3.5%, and average hourly earnings grew faster than expected. This is the perfect trifecta. It's an unambiguous sign of a red-hot economy. Within seconds, algorithms and human traders react. They sell the euro, the pound, the yen, and they buy the US dollar. The euro to US dollar chart, which shows how many dollars 1 euro can buy, plummets. The US dollar to Japanese yen chart, showing how many yen $1 can buy, skyrockets. The narrative is crystal clear. The Fed has every reason to be aggressive and raise interest rates. The dollar is king. Scenario 2, the disaster report. Again, the forecast was for 180,000 jobs. The number prints at a meager 20,000. Or even worse, it's negative, meaning the economy actually lost jobs. The unemployment rate unexpectedly ticks up, and wage growth stalls. The market's reaction is the complete opposite of our first scenario. This is a 5-alarm fire. It screams economic weakness, possibly even a looming recession. Traders dump the US dollar with incredible speed. They buy euros, pounds, and yen. The narrative shifts instantly. All talk of interest rate hikes vanishes. Instead, the market starts pricing in the possibility that the Fed might have to cut interest rates to stimulate the economy. A weaker economy and the prospect of lower rates make the dollar far less attractive, and its value falls accordingly. But the most common and often the most difficult scenario for traders is Scenario 3, the mixed report. This is where the data tells a conflicting story. Imagine the headline NFP number is very strong, say 275,000 jobs, well above the 180,000 forecast. Your first instinct is buy the dollar. But then you look at the other components. Average hourly earnings came in flat, showing zero growth. And the unemployment rate unexpectedly ticked up because more people entered the labor force looking for work, but didn't find it immediately. What happens now? Chaos. The market doesn't have a clear narrative. Some algorithms will react to the strong headline number and buy the dollar. Others will focus on the weak wage data, the inflation signal, and sell the dollar. The result is often extreme whipsawing volatility. The price might shoot up 50 pips, then crash down 70, then drift back to where it started, all within a few minutes. This is the market trying to digest conflicting information. Is the job growth good enough to overlook the lack of wage pressure? Or does the lack of wage pressure mean the Fed has no reason to raise rates, regardless of the headline number? In these moments, there is no easy answer, and the market becomes a treacherous place as big players battle for control of the narrative. Understanding these nuances is what separates a novice from a seasoned market observer. The NFP isn't just about one number. It's a story with three main characters: job creation, the unemployment level, and wage growth. The way these three characters interact determines the plot, and that plot dictates the short-term fate of the US dollar. It is the most direct, high-impact monthly snapshot of the American labor engine, and its pulse reverbs through every corner of the global financial system. But the health of the job market, as critical as it is, only addresses one half of the Federal Reserve's core mission. They have what's known as a dual mandate, to achieve both maximum employment and stable prices. The NFP gives us the clearest view on employment. But to understand the other, equally powerful force that drives Fed policy and moves the currency markets, we have to look at the price of everything. And that brings us to the single most important measure of inflation: the Consumer Price Index. The Consumer Price Index, or CPI, is the government's best attempt to answer a simple, yet incredibly complex question. How much more or less does it cost to live this month compared to last month? Imagine a giant hypothetical shopping cart. This isn't your average grocery run. This cart is filled with everything an average urban family buys. We're talking about the rent or mortgage payment for your house, the gasoline for your car, the price of a gallon of milk, and the cost of a doctor's visit. It includes the price of a new shirt, a plane ticket, your kid's college tuition, and even the cost of a movie ticket. The Bureau of Labor Statistics, the BLS, is tasked with tracking the price of this massive representative basket of goods and services. Every month, thousands of BLS data collectors go out and meticulously record prices for about 80,000 different items from thousands of retail and service establishments all across the country. They call homeowners to track housing costs. They monitor utility bills. It is a monumental undertaking, and the result is a single number that represents the overall change in prices. If the CPI goes up by 0.5% in a month, it means that, on average, you needed to spend 0.5% more to maintain the same standard of living as the month before. Now, for anyone watching the markets, this is where it gets critical. You'll always hear about two versions of the CPI: the headline CPI and the core CPI. The headline number is the big one. It includes everything in that shopping cart, all 80,000 items, including the most volatile ones, food and energy. The price of gasoline can swing wildly based on global events, and food prices can be affected by a bad harvest or supply chain disruptions. These dramatic swings can sometimes give a distorted picture of the underlying inflation trend in the economy. That's why economists, and more importantly, the Federal Reserve, pay incredibly close attention to core CPI. Core CPI takes the exact same basket of goods and services, but it removes food and energy prices from the calculation. The idea is to strip out the noise and get a clearer signal of the more persistent underlying inflation pressure. Is the cost of rent, medical care, and new cars, things that don't change price day to day, steadily rising? That's what core CPI tells us, and it's often a better predictor of future inflation trends. So, why does this one report have the power to send shockwaves through the global currency markets? Because it speaks directly to the Federal Reserve's soul. Remember the Fed's dual mandate: maximum employment and stable prices. Stable prices is their polite way of saying keep inflation under control. For decades, their unofficial, and now official, target for healthy inflation has been around 2% per year. The CPI report is their primary report card. It tells them how well they're doing on one half of their entire job. When the CPI number comes in hot, meaning higher than expected, alarm bells go off at the Federal. It's a signal that the economy is overheating, that too much money is chasing too few goods, and that the purchasing power of the US dollar is eroding. To combat this, the Fed's primary weapon is raising interest rates. Higher rates make it more expensive for businesses to borrow and expand, and for consumers to take out loans for cars and homes. This cools down demand, slows the economy, and in theory brings inflation back down. Conversely, if the CPI report is cold, coming in lower than expected or even showing deflation, the Fed gets worried about the opposite problem. A slowing economy could lead to job losses. In this scenario, they're more likely to consider lowering interest rates to make borrowing cheaper, encouraging spending and investment to stimulate economic growth. This direct link between CPI, Fed policy, and interest rates is the entire game for Forex traders. Higher interest rates make a country's currency more attractive to foreign investors. If you can earn a 5% return on a safe US government bond versus a 2% return on a European one, you're going to sell your euros, buy US dollars, and invest in the US. This increased demand for dollars drives its value up. So the logic chain is simple but powerful. A hot CPI report leads to expectations of higher interest rates, which leads to a stronger US dollar. A cold CPI report leads to expectations of lower interest rates, which leads to a weaker US dollar. The day the CPI report is released, typically around the middle of the month at 8:30 a.m. Eastern Time, is like the Super Bowl for economic news traders. The moments leading up to the release are filled with an electric tension. The market is pricing in a certain expectation, a consensus forecast from a poll of leading economists. What everyone is waiting for is the surprise. It's not the number itself that matters as much as how that number compares to what the market was expecting. Imagine it's 8:29 a.m. The euro to US dollar currency pair is trading in a tight, quiet range. Traders around the world are holding their breath. At 8:30 a.m., the number flashes across the screen. The consensus was for a 0.3% monthly increase, but the actual number comes in at 0.6%. It's a massive beat, a huge inflationary surprise. In a fraction of a second, algorithms and human traders react. The probability of a future Fed rate hike just skyrocketed. The dollar becomes instantly more attractive. Orders to buy the US dollar flood the market, and the price of euro to US dollar can plummet hundreds of pips in a matter of minutes. That's the raw power of a single data point. We saw a perfect case study of this throughout 2021 and 2022. As the world emerged from the pandemic, supply chains were a mess and government stimulus had flooded the system with cash. Month after month, the CPI reports came in hotter and hotter than anyone predicted. At first, the Fed called it transitory, a temporary blip. But the data kept screaming that inflation was becoming entrenched. Each CPI report that beat expectations put more and more pressure on the Fed to abandon its easy money policy. And they did. They embarked on one of the most aggressive rate hiking cycles in history. And what happened to the US dollar? It went on an absolute tear. The US dollar index, or DXY, which measures the dollar against a basket of other major currencies, soared to 20-year highs. The euro briefly fell to parity with the dollar, €1 for $1, for the first time in 2 decades. This wasn't a coincidence. It was a direct, real-world consequence of CPI data, forcing the Federal Reserve's hand, and the global currency markets responding to those changing interest rate expectations. But the most sophisticated market participants don't just look at the headline or even the core number. They dive deep into the report's components. They ask, what exactly is causing the inflation? Is it another spike in used car prices that will likely reverse? Or is it a rise in something sticky, like rent? The cost of shelter is a huge component of the CPI, and it tends to be very persistent. If the report shows that sticky, services-based inflation is on the rise, it's a much more significant concern for the Fed than a temporary jump in airfares. This deeper analysis of the report's internals can provide clues about the Fed's next move long before they ever announce it. So, the Consumer Price Index isn't just a boring government statistic. It's a direct gauge of the economic health and purchasing power of every American. For the Forex market, it's the primary piece of evidence that dictates the future path of interest rates, the single most important driver of a currency's strength. Tells us the story of what consumers are paying. But there's another side to this story. A leading indicator that tells us about the costs businesses are facing before those costs ever get passed on to us at the checkout counter. And that brings us to the CPI's less famous, but critically important cousin, the Producer Price Index. The Producer Price Index, or PPI, is essentially the CPI for businesses. It measures the change in prices that producers receive for the goods and services they sell. Think of it as the price tag on a pallet of lumber leaving the mill, the cost of 1,000 microchips leaving the factory, or the wholesale price of a truckload of avocados before they even get to the grocery store. It's inflation at the source. So why should a Forex trader care about the wholesale price of avocados? Because the PPI is a crystal ball for the CPI. It's the whisper of future inflation. If the costs for producers are rising, it's a very strong signal that those higher costs will eventually be passed down the supply chain. The factory pays more for steel, so they charge the car dealership more for the car, and in a few months you pay more for that car on the lot. This journey of price increases is often called the inflation pipeline, and the PPI is the first reading we get from the very start of that pipeline. When the PPI report is released by the Bureau of Labor Statistics, it often comes in three main flavors: prices for crude goods, intermediate goods, and finished goods. This gives economists and traders a granular view of where the price pressures are building. Is it raw materials like oil and iron ore? Or is it in semi-finished parts like engines and circuit boards? Or is it at the very end with the finished products ready for sale? A spike in crude goods prices is an early warning, but a spike in finished goods prices means consumer inflation is right around the corner. Now, let's connect this to the currency markets. Imagine the PPI data is released, and it comes in much hotter than analysts expected. The PPI final demand number, which measures the prices for goods, services, and construction sold for personal consumption, is up 0.8% for the month, when everyone was only expecting 0.3%. What happens in the mind of a global currency trader? Instantly they think, wow, producer costs are surging. That means consumer inflation, the CPI, is almost certainly going to be high next month. And what does high and persistent inflation mean? It means the Federal Reserve is going to feel immense pressure to continue its policy of raising interest rates to cool down the economy. Higher interest rates in the US act like a magnet for global capital. An investor in Japan or Germany looks at the potential return on a US government bond and sees it climbing higher and higher. They think, why would I keep my money in euros earning 0.5% when I can convert it to US dollars and earn 4%? So they sell their euros and buy US dollars to invest in those higher-yielding assets. This massive wave of demand for the dollar pushes its value up against other currencies. The euro to US dollar pair would likely fall, and the US dollar to Japanese yen pair would likely rise. A hot PPI report can be the spark that lights the fire under the US dollar, all because it gives a sneak peek into the future of inflation. So we have our two inflation titans, the CPI, which shows us the pain in our wallets right now, and the PPI, which shows us the pain that's coming down the road. They are a powerful duo that directly influences the Federal Reserve's number one enemy, inflation. But the Fed has what's called a dual mandate. Their job isn't just to keep prices stable. It's also to achieve maximum employment. They have to walk a tightrope. If they raise interest rates too aggressively to fight inflation, they risk slowing the economy down so much that businesses stop hiring, or worse, start laying people off. This would violate the second part of their mandate. This brings us to the most watched, most anticipated, most market-moving economic report on the entire planet, the U.S. Jobs Report. Officially known as the Employment Situation Summary, this report is released by the Bureau of Labor Statistics, typically on the first Friday of every month at 8:30 a.m. Eastern Time. For professional traders, this day is known as NFP Friday, and it is pure, unadulterated chaos and opportunity. The minutes before and after this release are some of the most volatile periods in the financial markets all month. Entire trading careers can be made or broken in the blink of an eye. But why? What's inside this report that holds so much power? It's not just one number. It's a deep, comprehensive health check of the U.S. labor market. And it's built on three pillars that every trader knows by heart. The first, and the undisputed heavyweight champion, is Non-Farm Payrolls, or NFP. This is the headline number. It represents the total number of paid U.S. workers of any business, excluding general government employees, private household employees, employees of nonprofit organizations, and farm employees. It's a direct measure of how many jobs were created or lost in the previous month. Think of it as the economy's heartbeat. A strong positive NFP number, say 300,000 jobs added, suggests the economy is vibrant, businesses are confident, they're expanding, and they're hiring. It's a sign of robust economic health. A weak or negative number suggests the economy is stagnating or contracting. Businesses are fearful, they're cutting back, and people are losing their jobs. The second pillar is the unemployment rate. This is the number you hear about on the evening news. It's the percentage of the total labor force that is jobless but is actively looking for work. A low unemployment rate, say 3.5%, is generally a sign of a very strong labor market. It means almost everyone who wants a job has one. However, traders look deeper. They also watch the labor force participation rate. Sometimes the unemployment rate can fall for a bad reason, because people have gotten so discouraged they've stopped looking for work altogether. If you're not actively looking, you're not counted as unemployed. So, a falling unemployment rate combined with a rising participation rate is the true sign of a healthy market. The third, and increasingly important pillar, is average hourly earnings. This is the direct link back to our old friend, inflation. This number tells us how quickly wages are rising for employees. If NFP is strong and wages are growing rapidly, it's a double-edged sword. On one hand, it's great. People are earning more money. But from the Federal Reserve's perspective, it can be a major red flag. Why? It's the dreaded wage price spiral. If wages go up, people have more money to spend. This increased demand for goods and services can push prices up. As prices go up, workers then demand even higher wages to keep up with the cost of living, which gives them more money to spend, which pushes prices up again. It's a vicious cycle that can lead to runaway inflation. The Fed watches this number like a hawk. So let's put it all together. It's NFP Friday. The market is holding its breath. The consensus forecast from economists is for 200,000 new jobs, an unemployment rate of 3.7%, and average hourly earnings growth of 0.3%. At 8:30 a.m., the numbers flash across the screen. NFP comes in at a massive 350,000. The unemployment rate drops to 3.5%. And average hourly earnings jump by 0.6%. This is what traders call a trifecta, a blowout report across the board. What happens to the US dollar? It explodes higher. The logic is swift and brutal. A report this strong tells the market that the US economy is running incredibly hot. The labor market is tight, and wage pressures are building. In this scenario, the Federal Reserve has no choice but to be aggressive. Any thoughts of pausing interest rate hikes or cutting rates are thrown out the window. The Fed now has a clear green light to raise rates to fight the inflationary pressures that this hot jobs market will create. Global investors see this and immediately pile into the dollar. They sell their pounds, their yen, their Swiss francs, and buy US dollars to capture the higher yields that are now almost certain to come. Within seconds, the euro to US dollar can plummet 100 pips. The US dollar to Japanese yen can scream higher by 150 pips. The sheer force of this one report realigns the entire global currency landscape in a matter of minutes. Conversely, a big miss, say NFP comes in at only 50,000, has the opposite effect. It signals a rapidly cooling economy, takes the pressure off the Fed, and can cause the dollar to tumble as traders price in the possibility of lower interest rates in the future. We've now seen how inflation and employment, the Fed's dual mandate, create seismic shifts in the Forex market. But there's another piece to this puzzle. A job is only half the story. The other half is what people do with the money they earn. Are they confident? Are they spending? The health of the American consumer is arguably the ultimate driver of the US economy. And that strength is measured by one of the most direct reports of all retail sales. This report, released monthly by the US Census Bureau, is exactly what it sounds like, a measure of the total sales of goods by retailers, from department stores to car dealerships to e-commerce giants. Now, why does this one report cause such a stir? Because consumer spending is the bedrock of the US economy. It accounts for roughly 70% of the nation's entire economic activity, or gross domestic product. 70%. So, when you want to know if the economic engine is firing on all cylinders or sputtering, you look at what the consumer is doing. The retail sales report is our most direct, high-frequency snapshot of that activity. But like any major economic report, the devil is in the details, and traders rarely just look at the headline number. They immediately dissect it. The first thing they do is strip out the most volatile components to get a clearer picture of the underlying trend. The most significant of these is automobile sales. Think about it. A single car purchase is a huge transaction. A slight shift in manufacturer incentives or a big order from a rental car company can cause auto sales to swing wildly from one month to the next, masking what's really happening in the rest of the retail landscape. That's why you'll always hear analysts talk about core retail sales, which is simply retail sales excluding automobiles. This core number is often seen as a more reliable indicator of broad consumer spending patterns. And we can go even deeper. Another volatile component is gasoline. The price at the pump can fluctuate dramatically due to global oil prices, not because Americans are suddenly driving more or less. To account for this, analysts also look at retail sales ex-autos and gas. This gives an even purer read on discretionary spending, what people are choosing to buy, not what they're forced to pay for a tank of gas. So, how does this translate into currency movements? Let's walk through a scenario. The market consensus, based on economists' forecasts, is for retail sales to increase by a modest 0.3% for the month. The report is released, and the number is a blockbuster, a 0.9% increase. Core sales are also exceptionally strong. The immediate reaction in the Forex market is predictable. Traders see this as a sign of a robust, potentially overheating economy. Confident consumers are spending freely, which fuels demand. When demand outstrips supply, what happens? Inflation. And who is the sworn enemy of inflation? The Federal Reserve. A strong retail sales number tells the Fed that the economy can handle higher interest rates. It gives them the green light to be more hawkish, to either raise rates or keep them higher for longer to cool things down. For a currency trader, the expectation of higher U.S. interest rates makes the dollar a more attractive investment. You can earn a higher yield by holding dollars compared to, say, euros or yen. As capital flows into the U.S. to chase that higher return, the demand for the dollar surges, and its value rises against other currencies. The euro to US dollar pair would likely fall, and the US dollar to Japanese yen pair would likely climb, all within seconds of that data release. Now let's flip the script. The same forecast of a 0.3% rise is in place, but the report comes out and it's a disaster. A negative 0.6%. Consumers are snapping their wallets shut. This is a major red flag. It signals economic weakness, declining demand, and dissipating inflationary pressures. For the Federal Reserve, this is a dovish signal. It tells them that the economy is fragile and might need support. The market immediately begins to price in the possibility of the Fed cutting interest rates to stimulate spending. Lower interest rates make the US dollar less attractive. Investors will look elsewhere for better returns, selling their dollars to buy other currencies. The US dollar index would likely tumble, and you'd see pairs like euro to US dollar rally sharply. This is where you see the interconnectedness of all these economic reports. A strong non-farm payrolls report, which we covered earlier, shows that more people are employed and earning money. A strong retail sales report then confirms that those people are actually going out and spending that money. This spending in turn can lead to a higher consumer price index or inflation down the road. A trader isn't just looking at one number in isolation. They are building a narrative. They see strong jobs, then strong spending, and they start anticipating a hawkish Fed and a stronger dollar long before the Fed even meets. But retail sales, as powerful as it is, tells us what consumers did last month. It's a look in the rearview mirror. What if there was a way to gauge what they're about to do? What if we could measure their mood, their optimism, or their fear? That's where sentiment indicators come in, and they are a crucial piece of the puzzle. These reports attempt to quantify confidence. The two titans in this space are the Conference Board's Consumer Confidence Index, or CCI, and the University of Michigan's Consumer Sentiment Index. Both are based on monthly surveys of thousands of households across the country. They ask people questions about their personal financial situation, their short-term and long-term outlook for the economy, and their plans for making major purchases. In essence, they are a report card on the collective psyche of the American consumer. These surveys are typically broken down into two key components. First, the Present Situation Index, which asks people how they feel about current business and labor market conditions. Second, and often more important for Forex traders, is the Expectations Index. This asks people about their outlook for the next 6 months. Will their income go up? Will there be more jobs available? Will business conditions improve? This forward-looking component is what makes these reports so valuable. A sharp drop in the Expectations Index can be an early warning sign that consumers are about to cut back on spending, even if the Present Situation Index is still strong. It's like seeing storm clouds gathering on the horizon before the first drop of rain has fallen. So, how do traders use this? A high and rising consumer confidence number is a bullish sign for the U.S. economy, and by extension, the dollar. It suggests that people feel secure in their jobs and optimistic about the future. An optimistic consumer is more likely to buy a new car, renovate their kitchen, or book a vacation. This points towards future strength in retail sales and GDP growth, giving the Fed more reason to stay hawkish. Conversely, a low and falling confidence number is a major bearish signal. It suggests consumers are worried about layoffs, rising prices, or a potential recession. A fearful consumer saves more and spends less. This can become a self-fulfilling prophecy, where the fear of a recession actually causes one by triggering a sharp pullback in spending. This is a profoundly dovish indicator, signaling to the market that the Fed may need to step in with rate cuts to restore confidence, which would be negative for the dollar. It's important to understand the nuance here. There can sometimes be a disconnect between how people feel and what they actually do. This is the classic confidence versus action debate. You might have a situation where confidence is low because of scary headlines about inflation, but people continue to spend because they have savings built up. Or confidence might be high, but people aren't buying houses or cars because interest rates are just too high. This is why no single report is a magic bullet. Traders compare the sentiment data from the confidence reports with the hard data from the retail sales report. When both are telling the same story, for instance, confidence is plummeting and retail sales are falling, it creates a very powerful high conviction signal for the market. So we've looked at the consumer from two critical angles: what they are actively doing with their money through retail sales, and how they are feeling about the future through consumer confidence. But the consumer is only half the story. To get the full picture, we need to look at the engine room of the economy, the manufacturing and service sectors. We need to know if factories are humming, if orders are piling up, and if businesses are expanding. That's where we turn to one of the most trusted forward-looking indicators in finance: the PMI. The PMI, or the Purchasing Managers' Index, is one of the most closely watched economic indicators for a simple reason. It's a survey of the people on the front lines. It's not a backward-looking government report compiled from old data. It's a real-time pulse check of the economy, taken directly from the purchasing managers at hundreds of companies across the country. These are the people who are actually placing the orders, managing inventories, and hiring staff. They see shifts in demand before they ever show up in GDP or employment reports. This is what makes the PMI a powerful forward-looking indicator. The report is compiled into a single index number, and the magic number here is 50. A reading above 50 indicates that the manufacturing or service sector is expanding. A reading below 50 signals that it's contracting. It's that simple. But the nuance is in the details. A reading of 51 is technically expansion, but it's weak. A reading of 58, on the other hand, signals robust, booming growth. Conversely, a reading of 49 suggests a slight contraction, while a reading of 42 points to a severe downturn. The market pays attention not just to the number itself, but to the direction and velocity of the trend. Is the PMI climbing month after month? Or is it falling? In the United States, there are two main PMI reports that traders watch, both released monthly. The first is the ISM Manufacturing PMI, which, as the name suggests, surveys purchasing managers in the manufacturing sector. It looks at things like new orders for goods, factory output, and raw material inventories. The second, and arguably more important for the modern U.S. economy, is the ISM Non-Manufacturing PMI, which is often called the Services PMI. This report surveys the vast services sector, which includes everything from finance and healthcare to retail and technology, and actually accounts for about 80% of U.S. economic activity. So, how does a number from a survey translate into wild swings in the currency market? It all comes down to a chain of cause and effect that reflects the health and attractiveness of the U.S. economy. Let's imagine the ISM Services PMI is released. The consensus forecast from economists was for a reading of 53.5, but the actual number comes in at a stunning 57.2. The market ignites. Why? A much stronger than expected PMI reading tells a powerful story. It says that service-based businesses are seeing a surge in new orders. They're busier, they're more confident about the future, and crucially, they are likely to hire more employees and invest more in their operations to meet this rising demand. This signals a strong, robust, and growing economy. For global investors, a strong U.S. economy is a very attractive place to put their money. They might want to buy U.S. stocks because companies are likely to post higher profits. They might want to buy U.S. bonds. To do any of this, they first need to buy U.S. dollars. This sudden increase in global demand for the dollar causes its value to appreciate against other currencies. So, in this scenario, you would likely see the euro to US dollar pair fall as the dollar strengthens against the euro, and the US dollar to Japanese yen pair rise as the dollar strengthens against the Japanese yen. Furthermore, a surprisingly strong economy, indicated by a high PMI, puts the Federal Reserve on alert. If the economy is running hot, it could lead to higher inflation. To combat that inflation, the Fed's primary tool is to raise interest rates. The mere prospect, the possibility of higher future interest rates makes holding US dollars even more attractive. International funds, often called hot money, will flow into the US to take advantage of the higher yield, further amplifying the demand for dollars and pushing its value even higher. Now let's flip the scenario. Imagine the market expects a PMI reading of 52, but the report comes in at a dismal 48.1. This is a shock to the system. A reading below 50 means the sector is now contracting. The story this number tells is one of economic weakness. Businesses are seeing fewer new orders. They're likely scaling back operations, putting expansion plans on hold, and may even be considering layoffs. This paints a grim picture of the US economy. International investors get nervous. They might start selling their US stocks and assets, fearing lower corporate profits and a potential recession. As they sell their US assets, they convert their US dollars back into their home currencies, creating a flood of US dollars onto the market. This increase in the supply of the dollar causes its value to depreciate. The euro to US dollar would likely rise, and the US dollar to Japanese yen would fall as the dollar weakens. From the Federal Reserve's perspective, a contracting economy is a major concern. The risk is no longer inflation, it's recession. To stimulate the economy, the Fed would be more inclined to cut interest rates, or at least signal that future rate hikes are off the table. Lower interest rates make holding US dollars less attractive compared to currencies of countries with higher rates. This encourages capital to flow out of the United States, further weakening the dollar. Let's look at a real-world case study. On June 3, 2022, the ISM Services PMI for the month of May was released. The market was expecting a slight drop to 56.4 from the previous month's 57.1. Instead, the number came in at 55.9, a bigger miss than anticipated and the lowest reading in over a year. The market reacted almost instantly. This sign of a cooling US economy, especially in its dominant services sector, led to a sell-off in the US dollar. In the minutes following the release, the dollar index DXY, which measures the dollar against a basket of other major currencies, took a sharp dip. The euro to US dollar, for example, jumped significantly as traders sold dollars and bought euros, pricing in the reduced likelihood of aggressive Fed rate hikes. This demonstrates the power of the PMI, but it also highlights a critical point for anyone watching these releases. The market's reaction is driven by the surprise. It's the difference between the actual number and the forecasted, or expected, number. If the PMI comes in exactly as expected, the market reaction might be minimal because that outcome is already priced in. It's the unexpected readings, the beats and the misses, that create volatility and opportunity. Digging even deeper, sophisticated traders don't just look at the headline number. They analyze the report's components. A strong headline PMI driven by a surge in new orders is far more bullish than one propped up by supplier deliveries. Why? Because a high supplier deliveries index actually means it's taking longer for suppliers to deliver goods, which is often a sign of supply chain bottlenecks and potential inflation, not necessarily organic economic strength. A surge in new orders, however, is an unambiguous sign of strong demand. Understanding the PMI is like having an inside look at the economy's engine room. It tells you whether businesses are stepping on the gas, hitting the brakes, or running into trouble. While GDP tells us where the economy has been, the PMI gives us one of our best clues as to where it's going. And in the fast-paced world of Forex, looking forward is everything. Of course, the health of corporations is only one half of the economic puzzle. The other, arguably more powerful half, is the American consumer. What are they thinking? Are they confident enough to open their wallets? Because when consumer spending accounts for nearly 70% of the entire US economy, their mood can make or break an economic trend. To gauge that, we turn to the vital signs of consumer sentiment. And there are two primary tools analysts and traders use to take this national temperature check. The first, and arguably the most famous, is the University of Michigan Consumer Sentiment Index, or MCSI. Picture this. It's the late 1940s. The war is over and America is booming. But an economist named George Katona at the University of Michigan has a groundbreaking idea. He believes that traditional economic models are missing a key ingredient: human psychology. He argues that how people feel about their financial future is just as important as how much money they actually have. So he starts calling people up. He starts asking them questions. Do you think you'll be better or worse off financially in a year? Is now a good time to buy a big-ticket item, like a car or a refrigerator? From those humble beginnings, the MCSI has become a monthly ritual for Wall Street. Every month, researchers survey hundreds of American households, asking those same fundamental questions. They compile the answers into a single number. A high number suggests optimism, a low number pessimism. But here's the critical part for a trader. The report is split into two subcomponents. The first is current conditions, which is how people feel right now about their current finances and willingness to buy. The second, and often more forward-looking, is expectations. This is the crystal ball component. It measures how confident people are about the future, about their income, business conditions, and the overall economy in the next year or even 5 years. This distinction is vital because it tells two different stories. People might feel okay right now but be terrified about the future, or vice versa. The second major player in this space is the Conference Board's Consumer Confidence Index, or CCI. While it also measures consumer sentiment through a survey, it has a slightly different flavor. The Conference Board, a business research group, places a heavier emphasis on the labor market. Its questions are more tilted towards jobs. Are jobs plentiful or hard to get right now? What do you expect business conditions to be like in 6 months? Think of it this way. If the Michigan survey is taking the consumer's emotional pulse, the Conference Board survey is checking their job security. Both are released monthly, and both can cause serious waves in the Forex market. So, how does a survey, a collection of feelings and opinions, actually move the US dollar? It all comes back to that chain reaction we've been talking about. Let's create a scenario. It's the last Friday of the month, 10 a.m. Eastern Time. The University of Michigan report is about to drop. Economists are expecting a reading of, say, 75.2. Forex traders around the world have their fingers hovering over the buy and sell buttons. The clock strikes 10. The number flashes across the screen, 85.0. A massive beat. It blows all expectations out of the water. Immediately, algorithms and human traders spring into action. What does that 85.0 mean? It means American consumers are feeling incredibly optimistic. They're confident about their jobs and their future earnings. And what do confident people do? They spend money. They book that vacation. They buy that new car. They renovate the kitchen. This surge in expected spending sends a powerful signal to the market. It suggests that economic growth is likely to accelerate. Businesses will see higher sales, they'll invest more, and they'll hire more workers. This creates a positive feedback loop. But for the currency market, the most important implication is what it means for inflation and the Federal Reserve. A wave of consumer spending can push prices higher. If everyone is trying to buy the same limited pool of goods and services, inflation heats up. And what is the Fed's primary mandate? To control inflation. When they see a number like this, a signal of roaring consumer demand, they may start thinking, we might need to raise interest rates to cool things down. Higher interest rates make holding US dollars more attractive to global investors because they can earn a higher return on their money. So demand for the dollar shoots up. In our scenario, you'd likely see the euro to US dollar pair drop, the US dollar to Japanese yen pair rise, and the dollar strengthen across the board, all within seconds of that number being released. Conversely, a shockingly low sentiment number triggers the opposite chain of events. A number that badly misses expectations suggests fear and uncertainty. Consumers are pulling back. They're saving, not spending. This signals a potential economic slowdown, or even a recession. A slowing economy means less inflationary pressure. The Federal Reserve, seeing this, might think, we may need to cut interest rates to stimulate the economy. Lower interest rates make the US dollar less attractive. Investors sell the dollar and move their capital to countries with higher-yielding currencies. The dollar weakens. All of this sparked by a survey measuring how people feel. But feelings are one thing. Actions are another. It's one thing for someone to tell a surveyor they plan to buy a new couch. It's another thing entirely for them to actually walk into a store and swipe their credit card. This is where we move from the psychology of the consumer to the hard data of their behavior. This is the Retail Sales Report. Released monthly by the U.S. Census Bureau, the Retail Sales Report is the closest thing we have to a real-time cash register receipt for the entire nation. It measures the total sales of all goods sold by retailers, from department stores and gas stations to restaurants and e-commerce giants. It is a direct, unfiltered look at whether consumers are actually spending. Now, when traders look at this report, They don't just look at the big, bold headline number. That number can be misleading. Why? Because it includes two extremely volatile categories: automobiles and gasoline. A big spike in gas prices can make it look like retail sales are soaring, when in reality, people are just paying more for the same amount of fuel and likely have less money to spend on other things. Similarly, auto sales can swing wildly from month to month based on promotions and inventory levels. To get a clearer picture of the underlying strength of the consumer, traders look at what's called core retail sales. This is the number that strips out those volatile auto and gasoline sales. It gives a much more stable and accurate reading of discretionary spending. There's even another version called the control group, which is even more refined and feeds directly into the GDP calculation. For a Forex trader, knowing the difference between the headline and the core number is fundamental. A strong headline number driven only by gas prices might be ignored by the market, while a surprise jump in the core number could send the dollar soaring. The market reaction to the retail sales report follows the same logic as the sentiment indexes, but it's often more potent because it's based on hard data, not just feelings. Let's imagine another scenario. The retail sales report is due out. Expectations are for a modest 0.3% increase in core sales. The number comes out, and it's a stunning 1% increase. The market explodes. This isn't a survey suggesting people might spend. This is concrete proof that they are spending, and in a big way. The chain reaction is swift and powerful. Strong spending means the economy is running hot. It suggests corporate profits will be high. But most importantly, it screams inflationary pressure. The Federal Reserve sees this, and the odds of a future interest rate hike increase dramatically. Traders don't wait for the Fed to act. They act immediately on the expectation of a more hawkish Federal. They buy the US dollar, anticipating that higher future interest rates will draw a flood of foreign capital into the country. The dollar index ticks up, and currency pairs react instantly. Of course, the opposite is just as true. A weak retail sales report, especially a negative number showing a contraction in spending, is a massive red flag. It's a direct sign that the main engine of the US economy is sputtering. Fears of a slowdown or recession immediately surface. This reduces inflationary pressure and increases the likelihood that the Fed will have to cut interest rates to support the economy. The dollar becomes less attractive, and traders will sell it. The key to understanding these releases, both sentiment and sales, isn't just the number itself, but the number relative to expectations. A strong report that everyone saw coming might cause a small ripple, but a report that completely shatters the consensus forecast, that's what creates a tidal wave in the Forex market. It's the element of surprise that forces a mass repricing of the US dollar's value. By looking at both how consumers feel and how they actually spend, traders get a comprehensive, two-sided view of the most important force driving the American economy. It's the difference between hearing the weather forecast and looking out the window to see if it's actually raining. Both pieces of information are critical, and together, they paint a picture that can point to the future direction of the world's most important currency. But consumers are only one side of the coin. What about the businesses that sell them all those goods and services? How is their health measured? That takes us to the engine room of the economy, the manufacturing and industrial sectors. The raw power of the industrial sector is the bedrock of any major economy. If consumer spending is the fuel, manufacturing is the engine that burns it. A healthy industrial base means jobs, innovation, and global competitiveness. A weak one can be a canary in the coal mine, signaling trouble long before it hits Main Street. Forex traders know this. They watch these reports with an intensity that borders on obsession, because they offer a direct look under the hood of the US economy. One of the first gauges they check is the Industrial Production Index, released monthly by the Federal Reserve. This report measures the real output of all US factories, mines, and utilities. It's a nuts and bolts indicator. How many cars were assembled? How much coal was mined? How much electricity was generated? It strips away the noise of prices and inflation to give a pure measure of physical volume. Think of it as the economy's physical strength test. A rising industrial production number suggests the economy is building muscle, becoming more robust. This is fundamentally positive for the US dollar. A strong, productive economy attracts foreign investment, and to invest in the US, you need US dollars. But the report gives us more than just a headline number. It also includes a crucial metric called capacity utilization. This tells us what percentage of the nation's total production capacity is actually being used. Imagine a giant factory that can run 100 machines, but is only running 85 of them. Its capacity utilization is 85%. If that number starts creeping up towards 90% or 95%, it's a sign that the economy is running hot. Demand is so high that businesses are using almost all their available resources. This can be a precursor to inflation. When factories can't easily produce more, they start raising prices. The Federal Reserve watches this like a hawk. High capacity utilization can pressure them to raise interest rates to cool things down, a move that typically sends the dollar soaring. So, a single report on industrial production gives traders a dual insight, a measure of current economic strength and a potential clue about future inflation and interest rate policy. However, as powerful as the industrial production report is, it's a bit of a look in the rearview mirror. It tells you what happened last month. In the fast-paced world of Forex, traders are desperate for a glimpse of the future. They want to know what's happening right now and what's likely to happen next. And for that, they turn to what is arguably one of the most important economic indicators on the planet, the Purchasing Managers' Index, or PMI. The PMI is a masterpiece of economic forecasting. It's not compiled from hard government data. Instead, the Institute for Supply Management, a private organization, simply asks the people on the front lines. They survey hundreds of purchasing managers across the country, the very people who are making the day-to-day decisions about buying raw materials, managing inventory, and hiring workers. They ask them simple questions. Are new orders up or down compared to last month? Is your production increasing or decreasing? Are you hiring or firing? Are your suppliers delivering faster or slower? The genius of the PMI is in its simplicity. The responses are compiled into a single number, and that number has a magic threshold, 50. If the PMI is above 50, it means the manufacturing sector is expanding. If it's below 50, it means the sector is contracting. It's a clear, unambiguous signal released on the very first business day of the month, giving the market its first comprehensive look at the previous month's economic health. Think of it this way. If GDP is the official history book of the last quarter, the PMI is the live field report from the scout on the front lines. It's telling you whether the army is advancing or retreating in real time. This is why it triggers such massive volatility in the currency markets. The market reaction hinges entirely on the element of surprise. Before the PMI is released, economists are polled to create a consensus forecast. Let's say the consensus is for a reading of 52.5, indicating modest growth. The market has already priced this expectation into the value of the US dollar. Now the moment of truth arrives. The actual number is released. If it comes in at 52.6, right on target, the market might barely move. But what if it comes in at 55? That's a huge positive surprise. It signals the economy is growing much faster than anyone thought. In an instant, algorithms and human traders will start buying the US dollar, anticipating that this strength could lead the Fed to be more aggressive with interest rate hikes. The euro to US dollar pair would likely plummet, and the US dollar to Japanese yen pair would surge. Conversely, imagine the forecast is 52.5, but the actual number is 49. A reading below 50 is a shock. It means the manufacturing sector, the engine of the economy, has unexpectedly stalled and is now going in reverse. This flashes recessionary warnings. Traders will dump the dollar, betting that the Federal Reserve will now be forced to consider cutting interest rates to stimulate the economy. A lower interest rate makes a currency less attractive, so capital flows out of the dollar and into other currencies. The surprise is what matters. The bigger the gap between expectation and reality, the more violent the reaction in the Forex market. These industrial indicators don't exist in a vacuum. They are intimately connected to the consumer data we talked about before, creating a powerful feedback loop. A weak PMI report, showing contraction, means businesses are seeing fewer new orders. To adjust, they cut back on production. If things get worse, they stop hiring and start laying people off. This directly impacts the Non-Farm Payrolls report. As unemployment rises, people have less money. They lose confidence. This directly impacts the Consumer Confidence Index. With less money and less confidence, they cut back on spending, which shows up as a weak retail sales report. And of course, when people aren't buying, businesses see even fewer orders, which can lead to an even lower PMI in the following month. It's a vicious cycle, and every data point is a link in the chain. Forex traders are watching to see if that chain is strengthening, creating a virtuous cycle of growth, or if it's beginning to break. Another critical piece of this industrial puzzle is the durable goods orders report. This measures how much money is being spent on big-ticket items that are designed to last for several years. We're talking about things like cars, washing machines, computers, industrial machinery, and the big one, aircraft. This report is a fantastic barometer of business and consumer confidence. When a company places a multi-million-dollar order for new machinery, it's a massive vote of confidence in the future. They wouldn't make that investment unless they expected strong demand for their products for years to come. However, the headline number can be notoriously volatile. A single massive order from Boeing for a fleet of 787s can dramatically skew the entire month's data, making it look like the economy is booming, when in reality, it was just one massive atypical purchase. Because of this, seasoned traders immediately look past the headline number to the core durable goods orders. This figure excludes the volatile transportation sector, aircraft, cars, and ships, to give a much more stable and accurate picture of underlying business investment trends. A steady rise in core durable goods orders is a powerful sign of a healthy, confident economy, providing a strong tailwind for the US dollar. It shows that the foundations of the economy are solid, as businesses are investing for long-term growth. So, a sophisticated trader isn't just looking at one of these reports. They're acting like a detective, piecing together clues to form a complete picture. They look for a narrative. Is the PMI showing expansion? Great. Is that confirmed by a solid industrial production number? Even better. And are core durable goods orders also rising? Now we have a story of a robust, investment-led recovery. That is a powerful high-conviction reason to be bullish on the US dollar. But if the clues conflict, if the PMI is strong but durable goods are weak, it creates uncertainty. And in the world of trading, uncertainty often leads to choppy, unpredictable markets. So we have the pulse of the consumer and the muscle of the industrial sector. We can see what people are buying and what factories are building. But how do you add it all up? How do you put one single number on the entire sprawling multi-trillion-dollar US economy? That brings us to the king of all economic indicators, the one that makes headlines around the globe. Gross domestic product, or GDP. It's the total value of everything, every car, every coffee, every haircut, every software subscription, every single good and service produced within a country's borders over a specific period, typically a quarter or a year. Think of it as the ultimate economic report card for the United States. It's the final score after a long, hard-fought game. A single number that attempts to capture the immense, chaotic, and powerful engine of the American economy. And for Forex traders, this number isn't just a score, it's a seismic event. When the US GDP number is strong, growing faster than expected, it sends a powerful signal to the world. The American economic engine is firing on all cylinders. Consumers are spending, businesses are investing, and the future looks bright. This creates a ripple effect that lands directly in the Forex market. A robust economy often leads to inflation, which in turn pressures the Federal Reserve to consider raising interest rates to cool things down. And as we've learned, higher potential interest rates act like a magnet for global capital, pulling in investment from around the world. Investors want to park their money where it can earn a higher return, and that increases demand for the US dollar, causing its value to rise against other currencies. Conversely, a weak or slowing GDP report paints a grim picture. It suggests consumers are pulling back, businesses are hesitant to expand, and the economy might be heading for a slowdown or even a recession. This is a red flag for the Federal Reserve. Their response is often to consider lowering interest rates to make borrowing cheaper and stimulate economic activity. This potential for lower returns makes the US dollar less attractive to foreign investors. They'll look for better opportunities elsewhere, selling their dollars to do so, which pushes the value of the USD down. So at its core, the GDP report is a major clue about the future direction of the Fed's monetary policy, and Forex traders are hanging on every decimal point. But here's where the real professionals separate themselves from the amateurs. They don't just look at the headline number. They pop the hood and look at the engine's components. GDP is generally broken down into 4 key areas. The first and largest is personal consumption. This is you, me, and everyone else in America buying stuff. It's the biggest driver of the US economy, making up roughly 70% of the total. Traders scrutinize this. Is GDP growing because people are confidently buying new cars and renovating their homes? Or is it because of something else? Strong consumption is a sign of a healthy, confident consumer base. The second component is business investment. This includes companies building new factories, buying new equipment, and stocking up on inventory. When this number is strong, it shows that businesses are optimistic about the future. They're willing to spend big money today because they expect to make even more money tomorrow. It's a powerful forward-looking signal. Third is government spending. This is everything from funding for new infrastructure projects to military expenditures. While it contributes to GDP, traders often view it with a bit more skepticism. A GDP number that's artificially propped up by a massive surge in government spending isn't seen as being as healthy or sustainable as growth driven by the private sector, by consumers and businesses. Finally, we have net exports, which is simply total exports minus total imports. If the US sells more to other countries than it buys from them, this number is positive and adds to GDP. If it imports more than it exports, which is typically the case for the US, the number is negative and subtracts from GDP. A narrowing trade deficit can be a positive sign for the economy's competitiveness. Understanding these components allows a trader to see the quality of the economic growth, not just the quantity. A 3% GDP growth driven by booming consumer spending and business investment is far more bullish for the dollar than a 3% growth driven entirely by government spending and inventory stockpiling that might be sold off next quarter. Now, let's talk timing, because in the world of trading, timing is everything. The GDP data is released by the Bureau of Economic Analysis in 3 stages for each quarter. First, you get the advance release, about a month after the quarter ends. This is the earliest look, and because the market craves new information, it almost always has the biggest impact. It's based on incomplete data, so it's subject to revision, but it sets the initial narrative. About a month later, we get the preliminary or second release, followed a month after that by the final release. While these are more accurate, most of their information has already been anticipated by the market. The big fireworks, the huge initial volatility, almost always happens on that first advance release. And this brings us to the most crucial concept in all of news trading: the power of expectations. The market almost never reacts to the number itself. It reacts to the number relative to what Wall Street expected it to be. Every major economic release is preceded by a consensus forecast, an average of predictions from a pool of leading economists. This forecast is the benchmark. This is the number to beat. Let's paint a picture. It's 8:29 a.m. Eastern Time on the day of the advanced Q1 GDP release. The consensus forecast is for 2% annualized growth. Forex pairs like Euro to US dollar and US dollar to Japanese yen are quiet, coiled like springs, with traders around the world holding their breath. The clock strikes 8:30 a.m. The number flashes across the screens. 2.9%. A massive beat. The US economy is growing nearly 50% faster than anyone predicted. Instantly, algorithms and human traders act. The US dollar index, DXY, rockets upward. On the charts, you see a huge green candle for the dollar. Euro to US dollar plummets as the euro weakens relative to the suddenly stronger dollar. US dollar to Japanese yen soars as the dollar strengthens against the Japanese yen. The narrative is clear. The US economy is a powerhouse, and the Fed has every reason to stay hawkish, keeping interest rates high. Now let's rewind and play a different scenario. Same setup, same 2% expectation. But at 8:30 a.m., the number comes in at a dismal 1.1%. A huge miss. The reaction is the complete opposite. The dollar gets hammered. The DXY chart shows a massive red candle. Euro to US dollar spikes upward, and US dollar to Japanese yen tumbles. The market's interpretation is that the US economy is sputtering, and the Fed might be forced to cut interest rates sooner than planned to prevent a recession. The story flips in a nanosecond, and fortunes can be made or lost in the ensuing volatility. And what if the number comes in exactly at 2%? Often, the reaction is surprisingly muted. This is because the expected news was already priced in. Traders had already adjusted their positions in the days and weeks leading up to the report based on that 2% expectation. When the reality matches the expectation, there's no surprise. And with no surprise, there's often no major move. The big money is made on the disconnect between perception and reality. GDP is the ultimate confirmation. While indicators like PMI and consumer confidence give us hints about the direction of the economy, GDP tells us what actually happened. It's the lagging heavyweight champion that validates or invalidates all the forward-looking speculation that came before it. It ties together the story told by the jobs numbers, the inflation reports, and the retail sales figures into one comprehensive narrative of economic health. We've now covered the pillars of U.S. economic news. We understand the heartbeat of the labor market, the inflationary fever, the consumer's pulse, the industrial engine, and now the economy's final report card. We have all the individual pieces of the puzzle, but knowing what a piece looks like is one thing. Assembling the puzzle, especially when the pieces are moving and changing shape in real time during a volatile news release, is an entirely different skill. How do you take all this knowledge and forge it into a coherent strategy? How do you navigate the treacherous first few seconds and minutes of a news release without getting swept away by the chaos? That is the final, and perhaps most important part of our journey. So we begin with the most critical phase, the moments before a major release. This isn't a time for guesswork. It's a time for a pre-flight checklist. First, you must know the exact time of the data release down to the second. Have your economic calendar locked and loaded. Second, you need to understand the three crucial numbers: the previous reading, the consensus forecast, and the actual number that's about to be released. The market's reaction isn't just about the actual number in isolation. It's about how that number surprises the market relative to the forecast. A non-farm payroll number of 200,000 jobs is good, but if the market was expecting 300,000, that good number is a disappointment, and the dollar could fall. The deviation from the forecast is the engine of volatility. Before the release, you should already have your charts prepared. This means identifying the key technical levels of support and resistance on the currency pairs you're watching. Where are the recent highs and lows? Where are the significant daily or weekly price pivots? These levels are the potential battlegrounds where the price will react after the news hits. They act as your map in the fog of war. Without them, you're flying blind. The final step in your pre-release checklist is to formulate a plan with simple, if-then statements. For example, if the CPI number comes in significantly hotter than expected, and the price breaks above resistance level X, I will wait for a retest of that level before considering a long position on the dollar. Or critically, if the number is ambiguous or the market reaction is too chaotic, I will do nothing. Having a plan to stay out of the market is just as important as having a plan to get in. Now let's talk about the moment of the release. The first 60 seconds. For many retail traders, this is the siren's call, the moment of maximum temptation. And it is, without a doubt, the single most dangerous moment to trade. When that data hits the wires, high-frequency trading algorithms react in microseconds. Spreads on currency pairs can widen dramatically, from 1 or 2 pips to 10, 20, or even more. This means your cost to enter a trade skyrockets. You can experience severe slippage, where you try to enter at one price but get filled at a much worse one because the market is moving so fast. Trying to scalp this initial move is like trying to catch a falling knife in the middle of an earthquake. The odds are overwhelmingly stacked against you. This is why a patient, professional approach involves the hands-off rule for the first few minutes. Let the algorithms fight it out. Let the initial shockwave of volatility pass. Your job is not to predict the initial spike. Your job is to interpret the aftermath and find a high-probability entry based on how the market digests the news. The real money isn't in guessing the spike. It's in correctly identifying the trend that emerges once the dust settles. This brings us to the core of a sustainable news trading framework: analyzing the second wave. After the initial violent price swing, the market will almost always have a secondary reaction. This is where your opportunity lies. The first step is to observe the initial reaction. Did the market move in the direction you expected based on the data? How strong was the move? Did it blast through one of your pre-identified technical levels? Next, you watch for the pullback or consolidation. This is a critical phase. The initial move is often driven by pure algorithmic reaction and panic. The pullback is driven by early profit takers and the first wave of institutional traders who are now analyzing the data's deeper implications. Does the price pull back 50% of the initial move and then stall? Does it form a clear consolidation pattern, like a bull flag after a strong upward move? This pause is invaluable. It gives you a moment to breathe, assess the new landscape, and plan an entry with a much better risk-to-reward ratio. Let's walk through a hypothetical case study. Imagine it's non-farm payrolls Friday. The forecast is for 180,000 new jobs. On your euro to US dollar chart, you've marked a key resistance level at 1.0850 and a support level at 1.0780. Your plan is to wait and watch. The clock strikes 8:30 a.m. Eastern Time. The actual number flashes across the screen. A stunning 310,000 jobs. A massive beat. This is extremely bullish for the US dollar. Instantly, euro to US dollar plummets. It drops 70 pips in under 30 seconds, slicing right through your support level at 1.0780. The spread widens to 15 pips. You following your plan do nothing. You just watch. Over the next 2 to 3 minutes, the pair finds a temporary bottom and starts to bounce. This is the pullback. It rallies back up to 1.0780, the very support level it just broke. But it can't get back above it. The former support is now acting as new resistance. You see the upward momentum stall right at that level. This is the second wave opportunity. You could consider entering a short position here, placing a stop loss just above that 1.0780 level, and targeting the next support level lower down. Your entry is not a guess based on the news release. It's a calculated trade based on the market's confirmed reaction to the news, at a key technical level, with a clearly defined risk. That is the difference between gambling and trading. But it gets even deeper. A truly advanced approach involves contextualizing the data. A single report, even a big one like NFP, is just one chapter in a much larger economic story. How does this blowout jobs number fit with the recent inflation data? If CPI and PPI have been trending down, a hot jobs report might be seen as a temporary anomaly, and the dollar's strength might be short-lived. However, if inflation has also been stubbornly high, this strong jobs report reinforces the narrative that the Federal Reserve will have to stay hawkish, keeping interest rates higher for longer. That creates a powerful, multifaceted case for a stronger dollar. This is where you connect the dots. You're no longer just reacting to one number. You're building a fundamental thesis. You're thinking like the large institutional funds. Does this data point change the Fed's probable course of action? Does it align with the recent Fed speak we analyzed? When the technical picture, like the price action in our euro to US dollar example, aligns with a strong, multifaceted fundamental story, the potential for a sustained trend increases significantly. Ultimately, mastering the art of trading US economic news is less about complex indicators and more about mastering yourself. It's about having the discipline to do your homework before the release. It's about having the patience to sit on your hands during the most volatile and dangerous moments. And it's about having the analytical skill to interpret the market's reaction and wait for a clear, high-probability setup to present itself. The amateur sees a news release and thinks, "I need to be fast." The professional thinks, "I need to be right." The amateur tries to catch the lightning in a bottle. The professional waits for the storm to pass, and then navigates the resulting currents. This entire journey, from understanding the core economic reports to deciphering the nuanced language of the Federal Reserve, and finally to building a strategic framework, is about shifting your mindset. It's about moving from a reactive gambler to a proactive analyst. It's a continuous process of learning, observing, and refining your approach. The economic landscape is always changing, and your understanding must evolve with it. By embracing this process, you empower yourself with one of the most valuable skills in the financial world: the ability to understand the story the economy is telling, and how that story translates into the dynamic, ever-shifting world of the Forex market.